All right. Hello, everyone. We are at top of the hour. Still have some folks jumping in, but I'm going to go ahead and get started just to keep us on track with time today. Happy New Year. Welcome to 2026. And hopefully, you all have your goals in mind and in line for this new year. Speaking financially related, of course. If you do have any questions around those goals or how we can help you accomplish those goals, feel free to reach out. This year, we're excited for our slate of webinars coming up. We have our whole calendar out, and I'll show you where you can find that afterwards. We got a lot of different topics we're going to cover this year, which I'm really excited about. Wanted to take a little bit of a different approach this year with some of the topics. So half of them are going to be a little bit more deep dive into specific individual topics, while others are going to be a little bit more general. And so hopefully that'll be good coming this year. Again, at the end of this slideshow, I'll have where you can go to access that calendar and register for the upcoming webinars. Really excited for this one today, talking about the most popular question that we get when it comes to financial planning and retirement planning is pre-tax versus Roth. How should I be contributing to my retirement accounts, pre-tax versus Roth? So we'll cover a few different things today, but if anybody is new to our webinars, again, we do these every month. So most of you should know us at GBS Retire by now. GBS Retire, we are financial advisors, mainly focusing on retirement plans and financial planning, helping people get to retirement. And we're always a free resource for you. Most of you are either coming through a plan that we're helping on the management side, or through GBS Benefits as a benefits employer, or through the Levitt Group as well. So there may be a few different ways that you're finding us today. But welcome to our webinars and presentations that we go through every month. Hopefully you find these of value. So we'll go cover a few different things today around pre-tax versus Roth. Now, I wish I could tell you that by the end of this presentation, I'm going to say exactly, if you're in this boat, do pre-tax. If you're in this boat, do Roth. But it's not quite that simple, right? There is a lot that goes into this analysis and evaluation of pre-tax versus Roth. So I'll start off with just a quick definition, just level set, make sure we're on the same page with terminology, and then we'll touch on one of the main factors in taxes now versus taxes later, right? It all comes down to taxes. So we'll touch on that as well as the retirement tax equation, but that leads into a little bit of how taxes now versus taxes later may not be the most important factor when it comes to this analysis. And then lastly, legacy planning and estate planning are always a big factor when it comes into pre-tax versus Roth as well. Like I said, feel free to drop questions in the chat. I'm happy to make this a little bit more interactive, and I do have a bunch of examples to go through as well. So just to level set on the terminology here, what we're talking about is contributions to your retirement accounts, right? Contributions to your qualified retirement accounts, either a 401k, a 403b, a 457, or even individual retirement accounts, can be made as either pre-tax, which we sometimes call the traditional retirement contributions, or Roth, which are sometimes referred to as post-tax contributions. And it all has to do with taxes, right? Do you want to pay taxes now or pay taxes later? The traditional pre-tax contributions are where we defer those taxes to retirement. So you get that tax benefit, that tax deduction today, and then when you take that money out in retirement, that is added on to your ordinary income and taxed at ordinary income tax rates. So when it comes to qualified retirement accounts, there are no capital gains tax rates. It is all ordinary income as it comes out of these accounts. Roth is the opposite. Roth is where the money goes in post-tax, so after taxes are taken out, money goes into the account, and then it grows tax-free. Assuming you're at least 59 and a half and have had the account open for at least 5 years, everything you take out of a Roth account is going to be tax-free. Okay. There's a few other considerations that you can go through there, such as the Social Security, RMDs. We'll touch on all of that here in a little bit as well, but I just wanted to make sure we did a level set on the terminology here. Sometimes it's confusing when we call the traditional contributions pre-tax. That just means they go into the account before any taxes are taken out. So when I refer to them as pre-tax contributions, that is going to be the traditional contributions to the account. All right, I want to start off with a quick example here. We're going to talk about James and his situation for a minute. James, who's 35, makes about $120,000 a year in 2026, and he's planning to save $10,000 this year. He has a choice between pre-tax and Roth, like most of us do. Let's say for option one with pre-tax James, he puts $10,000 into the traditional 401k. He gets a tax deduction or tax benefit today. Let's say because he's in $120,000, he's in roughly the 24% tax bracket. maybe on the border 22, 24. We can assume 24% for this example. He saves $2,400 in current taxes today. That's 24% of the $10,000. These retirement contributions always come out above the line on your taxes, which means it lowers your overall taxable income, and then the rest of your income is calculated to determine your tax liability. So it's a direct, easy savings on taxes for the current year. He feels pretty smug about that and decides, hey, I saved $2,400. I'm getting that much in my refund. Next year, I'm going to go to Costa Rica or whatever, right? He's going to spend that money because he's saving that from his taxes. Let's fast forward to retirement. Traditional retirement age 67, that $10,000 grows to $242,000, assuming about 10% rate of return. Every dollar that he takes out is ordinary income tax, and it always goes in on top of any other income. So typically at your top tax bracket is how that is taxed. And taxes are whatever the IRS say they are at that time. We don't know what taxes are going to be like in the future, but we're going to assume for this example about 15%, which I would say is a little bit high for most retirees. But assuming 15%, that means over 36,000 is going to taxes. Flip the script here and say Roth James puts 10,000 into a Roth. He pays that $2,400 today, sacrifices a little bit, right? He's not able to go on that Costa Rica trip just yet. Fast forward to retirement, that 10,000 grows to the same 242,000. Withdrawals now are completely tax-free. The IRS is not invited to the party at all. $36,313 is the extra that he receives after taxes take effect. And he can go on a very luxurious trip. I don't know if Spain's better than Costa Rica. I haven't been to either, but for this example, he's going to Spain. Money left over to contribute to grandkids, whatever his goals are at that point, just because he has $36,000 extra as opposed to pre-tax James. Now, I know you're saying, well, hang on, doesn't tell the whole story. It's not comparing apples to apples, and I'll get to that here in a minute. But in this just very simple example, it looks like Roth is the winner, right? And if we're comparing, a dollar into pre-tax versus a dollar into Roth, yes, Roth often looks the winner regardless of what your tax rates are in retirement. Now you'll notice that James gets the benefit, or pre-tax James gets the benefit today. He gets the tax benefit today and is able to enjoy his money a little bit more. Roth James gets the tax benefit in retirement and is able to enjoy that benefit at that time. So pre-tax versus Roth, taxes now versus taxes later, maybe not the most important questions to be considering. Often it's what problem are we trying to solve? What goals are we trying to accomplish with this money? Whenever I talk about financial planning, we always come back to those goals, right? What are our goals for this money? But taxes now versus taxes later is typically how we start this analysis. If we're doing pre-tax right now, we're betting that taxes are going to be lower in the future, whether that's with taxes dropping or just we're in a lower tax rate because we have less income in retirement. Roth is the opposite. Roth bets that taxes are going to be higher in the future. So we're paying those taxes today. We don't have any control over that, right? The IRS typically decides what, and then the administration decides what's going to be taxed at what time. This is an important distinction as well that I like to clarify. There is a difference between our top tax bracket and our effective tax rate, right? We have a progressive tax system, meaning that the first dollars are taxed at a lower rate than the last dollar taxed. What that means when we're evaluating pre-tax versus Roth is that we're often evaluating and doing our math based on your top tax bracket or your marginal tax rate. That's going to be the rate that every dollar is taxed at the very top of your income. And because, like I mentioned before, if you contribute with pre-tax, that takes off the top part of your income based on how much you contribute. That's going to be saving or costing you, if it's with Roth, money at your top tax rate. And so we see just a quick little diagram here that I like that shows the difference between our marginal top tax bracket and the effective tax rate on average across the board. So you see that you're never actually paying 10% or 12% or 22% in taxes on everything because it's a progressive tax system. So whenever we're doing these analysis, yes, our effective tax rate can be important to consider, but it's often at that top tax rate that we're doing the numbers. So I'm going to go over two really simple examples. This one right here is a bit of an extreme example, but bear with me, that show when Roth makes sense and when pre-tax can make sense. So Alex and Alice, early career, single income household, mid to let's say late 20s with 6 kids, which if you're in the Utah area, that's not too uncommon to have that many kids. Making $130,000 a year, top tax bracket, about 22%. Effective tax rate of 0%. And you think, well, hang on, that's not possible. Well, with 6 kids, $2,200 tax credit per kid, they're not going to have any tax liability for the year. So they could contribute 30,000, well, 24,000 this year, 24,500 to their retirement account. If they did all of that with pre-tax, they would be saving $0 in taxes today. Obviously, they'd want to do Roth, right? Obviously, they want to contribute as much as they're able to on their budget to Roth because they're paying 0% overall in taxes because of the tax credits that they get from kids. If they're assuming, say, 12% taxes in retirement, obviously 0% is less than 12%. So in this case, Roth makes sense. And yes, this is an extreme example, but we do see this quite frequently, right? Having kids is one of the very generous tax credits that we get nowadays. And so when people are younger, oftentimes Roth makes more sense. Fast forward a little bit. Let's say they're now in their mid 50s, late career, both working now. They're bringing home, $235,000, top tax bracket of 24%. Their kids have aged out of those tax credit ages. They don't have mortgage interest or any other, really other deductions. And so their top tax rate stays at that 24%. Their effective tax rate probably closer to 18, 19%. But as a reminder, in this analysis, we're saying comparing that top tax rate 24% now versus 12% in retirement. Obviously, it makes more sense now to contribute with pre-tax because you're in a higher tax bracket, higher top tax rate today. But the important thing that I want you to remember, and this is kind of where we compare apples to apples in this Roth versus pre-tax comparison, is if they're making a switch from Roth to pre-tax, they need to make sure and also invest their tax savings. So if they're saving 10%, and they're saving 24% on that, or whatever that number is, they need to also save their tax savings in order to make the comparison equal. Otherwise, Roth will still make sense, right? To drive that concept home, let's go back to the James example here. And let's say for pre-tax James still saves that same 10,000 into his traditional 401k, but instead of spending it on a trip to Costa Rica, we're going to make the bottom line equal between pre-tax and the Roth example. So instead of spending that 2,400, he now saves that 2,400, whether it's on top of his other retired 401k contributions or to an individual retirement account, he's eligible to do so. Doesn't matter. He's saving that extra tax savings. So now James has $12,400 that's able to grow in the account. Still, every dollar that is withdrawn is taxed as ordinary income, but instead of 242,000, he now has over 300,000 in that account. After the 15% tax rate in retirement, he has 255,000 of spendable money after those taxes are taken out. So now if we compare that 255,000 to the 242,000 of Roth money, then pre-tax wins. And so if we're just looking at the taxes now versus taxes later in a silo without looking at any other goals or other factors, then you have to make sure you're investing your tax savings in addition to your other contributions, because that is where pre-tax can win. Great question about investing your tax savings like we're talking about. You're talking about the money you keep from not paying taxes, so what's left in your check. Yeah, so let me break it down a little bit clearer. If, let's say, this was the first year that James was starting to contribute to his account, and he didn't change anything else from his tax withholding from his employer. So if he puts $10,000 in, nothing else changes, he's going to get $2,400 back as a refund next year when he files his taxes. That $2,400 then needs to be saved in order to invest your tax savings, like I'm talking about. The smart way would probably be to adjust your withholding to be a little bit less, and then you're able to save that extra amount each payroll period or each month. So whatever works for you in your mind to break it down, just make sure you're also saving your tax savings if you are doing the pre-tax route, because that's when it can win. Otherwise, if we're just comparing $1 into pre-tax, $1 into Roth, the $1 into Roth is always going to win. And oftentimes, when people get that $2,400 refund, whatever it turns out to be, it gets spent. So we have to have some discipline there to make sure that we're increasing our pre-tax contributions to make that an apples to apples comparison. Now, I mentioned it may not be taxes now versus taxes later may not be the most important question to be asking. And a lot of that comes down to the overall retirement tax equation. And what I mean by that is where all of our income is coming from in retirement and how we are customizing and strategizing that income at that time. Most of our income will come from Social Security and or a pension, right? Some people have pensions rather than a Social Security check in retirement. So whichever applies to you there. Pre-tax withdrawals, Roth withdrawals, and then taxable investments. Taxable investments include like another investment account or a brokerage account where you're holding in, stocks, bonds, mutual funds, other types of investments that aren't qualified. Most people have some or all of these types of income sources in retirement. And the goal is to have as much control over which bucket we're pulling from as possible. The more control we have and the more options we have, the better we're able to be more efficient in terms of taxes over retirement, right? A lot of times, if you meet with your CPA and you're talking about contributing pre-tax versus Roth, they're looking very short term. Just in this year, how do we save you income? How do we save you on taxes in this year? When really we want to be thinking long term. Yeah, we can save a couple $1,000s this year by doing pre-tax, but sometimes if we're looking at Roth or even doing some conversions, then we can be saving hundreds of thousands of dollars over 20, 30, 40 plus years. So the goal is really to have as much control as we can. And sometimes really the answer is to have a little bit of everything. As an example, let's say we have all pre-tax retirement income. So we've been saving to our pre-tax bucket. We have a little bit more because we're also investing our tax savings. So let's say we have $2 million in traditional pre-tax retirement accounts at retirement. We have about 30,000 from Social Security, which if you're concerned about Social Security, that's another conversation, right? There'll still be something for you. We're not going to get rid of it entirely, but for this sake, say 30,000 from Social Security, a retirement income need of about 100,000 per year before taxes. When you retire, we'll need to start pulling $70,000 per year from the retirement accounts to supplement that Social Security. After the standard deduction, top tax bracket's going to be about 22% in this example. Fast forward to 73, required minimum distributions start. Okay, required minimum distributions are the rule that we have to start taking money out of these pre-tax accounts to pay taxes on. The goal behind those RMDs is that the IRS says, hey, this hasn't been taxed. We want to tax it. Let's start taking it out a little bit at a time. And if you live to the old age of 121, the account will be completely depleted. So the idea is to deplete the account by 121. Most of the time that doesn't happen, and then it continues on in the estate. But once required minimum distributions start, it's based on a table. And assuming, right, some rate of return within the investments, year one RMD could be about $96,000. By 74, because the money is going to continue to grow a little bit at a time, assuming 4, 5, 6% return, the RMDs increase each year. The factor that you use to determine those required minimum distributions increases each year as well. So the tax bracket could jump to 24 as early as age 74 and up to 32% by age 80 to 82, again, depending on investment returns and what taxes are at that time. And so just because, yes, we're going to be in a 22% tax bracket in retirement, if you're on a 24% pre-retirement, that doesn't necessarily mean your tax bracket is going to stay at 22% for the duration of your retirement because required minimum distributions. We're not even calculating the fact that your Social Security is taxable depending on other income that you have, such as these distributions. So there's additional tax from on Social Security that we would need to factor in as well. So you're probably getting there's a lot of different factors that we take into consideration, and it's very hard to drill down perfectly. You should do all pre-tax or all Roth, but there are some things as we're going through that can help you make that decision. Last bullet point here, that post-death, so after passing, kids receive those accounts and then will pay taxes on their top tax bracket as they take it out. So let's go over an example of Roth. So now we have all Roth in our accounts. Again, comparing apples to apples, overall we contributed a little bit less because we weren't investing any tax savings along the way. So instead we have 1.5 million in our Roth accounts. Still have that 30,000 from Social Security, still have about 100,000 in before tax expenses. We only need to pull about 60,000 out because if it's coming from a Roth account, it goes a lot further without taxes. After the standard deduction and looking at how much Social Security is taxable, which in this case would be 0, your top tax bracket is 0. You don't pay any taxes in this example. Fast forward to 73, Required minimum distributions are not required. After passing, kids can, receive that as Roth and let it continue to grow for up to 10 years. And you think, oh, this is great. No taxes in retirement. But we're missing an opportunity here, right? And if we think, okay, we were in 22% tax bracket or whatever we were before retirement, and now our tax bracket is 0%, we had a higher tax rate pre-retirement than we did post-retirement. So really, we should have been doing pre-tax the whole time, right? Well, in this case, yes, at least a little bit. And so there's an opportunity. We don't want to have all Roth accounts either, because there is a little bit that we could pull from pre-tax accounts in this example to be a little more efficient. So the ideal approach is going to be kind of a balanced approach. The best scenarios that I see of people moving into retirement, working on that income strategy, is always having a little bit of both, right? Having a little bit of pre-tax, having a little bit of Roth in the accounts can really help to be more efficient long term. Example here, if we have a balanced approach using very similar numbers, instead of the 2 million, we now have 1.75 because we have a mix of pre-tax and Roth. Again, same scenario, 30,000 from Social Security, $100,000 a year income need in retirement. We're going to pull out, say, 45,000 a year from the pre-tax account, 20,000 from a Roth. After the standard deduction, tax rate is now 12% as opposed to the 22% that it was before. Fast forward to the required minimum distribution age. Those RMDs are typically satisfied with your normal distributions from your pre-tax accounts because that's a lower overall balance. And so the top tax rate stays pretty much flat throughout your retirement. And then when you get close to passing, after death, then the pre-tax accounts are mostly drained. There may be a little bit left, but mostly drained. And anything left over is often the Roth accounts. That can typically be the most efficient long term, is to have a little bit of both in the account. I think I saw a question come in through, so I'm going to take a break while we digest this to look at some questions coming in. Great question from Betsy on I'm going to touch on that next, actually, through the legacy and estate planning around passing money on to kids. So typically the ideal approach is to have a little bit of both in there. And as a reminder, if you're doing Roth, typically any matching contributions or any employer contributions will go into the pre-tax side of the account. So you may have both already in there if you have been contributing with Roth. So important thing to keep in mind there. Now, another important factor that we like to consider is your goals for legacy and estate planning. Now, some people, they like to follow the approach of dying with zero, right? Where you spend down all of your assets and die with zero. Others have kids or grandkids that they want to help benefit from after they pass. And so it really comes down to your goals as well. The more you want to leave to your estate, oftentimes the more Roth makes sense. The more pre-tax can make sense as well. So what happens after we pass away? After we pass away, which is not a fun thing to think about, but it'll probably happen to all of us. Not probably, it will at some point. The pre-tax account will pass to an inherited IRA to any kids or grandkids. Spousal beneficiaries, just a quick note, they can essentially inherit that as their own and move that into their own retirement balance and then take distributions based on their life expectancy or just keep it in the account. So kids receive that as an inherited IRA. Inherited IRAs have different requirements than traditional individual retirement accounts. And that's to Betsy's point, where they are required to take it out by year 10. Now they can take it out a little bit at a time or 100% at year 10, but it is always taxed at their tax rate. So it would probably make sense to take it out a little bit at a time so that it doesn't have a large impact on your taxes in year 10. If it passes to grandkids, it's the same guidelines and rules as if it goes to kids. So your heirs in your estate receive those accounts essentially as income, not just assets. Now it does grow a little bit at a time if you're using that 10-year drawdown period, but it is always taxed at their tax rate once they take it out. If it's not a child or a spouse, essentially the same rules apply. There are slightly different rules if it is like a friend that is within 10 years of you. They can often stretch it out over their lifetime. But these rules that's kind of a newer rule. These rules are always changing a little bit at a time. But non-spousal or child beneficiaries follow the same rules, but there is an exception if they are within 10 years of you. in terms of age. So Roth accounts, like I mentioned, are a lot more efficient when it's passed on to your heirs. Tax-free withdrawals, so Roth accounts move over into a similar inherited IRA structure, but it's now a Roth. And again, 10-year drain period. They have to drain it by year 10. In most cases with the Roth, as you would expect, you allow it to continue to grow over that 10 years, and then you can take that lump sum completely tax-free, reinvest it, do whatever you want with it. So it can be very beneficial to them to not have to worry about any taxes. So I want to do just real quick an example around that and how important estate planning is. And it's not just for the wealthy, right? We all have some level of wealth within our retirement accounts. And like you see here, account type matters just as much as the account value. So comparing again, apples to apples, $2 million of pre-tax money in the estate, 1.76 million of Roth money in a separate estate. With the pre-tax estate, kids inherit that tax liability, right? If they're at 22%, that's what it's going to be taxed at. If they're at 37% in the highest tax rate, it'll be taxed at 37%. Every dollar that comes out is added to ordinary income, just like for you. So in this example, 440,000 goes to the IRS. Whereas with the Roth, assuming we're able to get it taxed at 12% currently, then we're going to have about 1.76 million left over. They receive that completely tax-free. And then you can see the impact. If we invest that for 20 years at 8%, that 200,000 is going to grow to almost $1 million if they're going to turn around and invest it. So again, goals are probably the biggest factor around pre-tax versus Roth. And then it comes down to your individual situation, taxes now, tax credits, tax deductions you can get versus taxes in retirement. Just lastly, before I come back to some of these questions, I want to go through kind of a real world example with a client that we're working with, and they recently retired, are now in retirement, and looking at doing Roth conversions over the course of their retirement. Because this is a big piece too that we don't have quite enough time to go into. So if you want to go into this with your situation, let us know and we can go through some examples with you as well. But oftentimes what it looks like when someone is working in their working years, they have higher income. And then when they get to retirement, that income drops. And that's exactly what happened with this couple. They were working at higher income, retired, income dropped, and now there are some opportunities for Roth conversions. So they were doing pre-tax, which was great. It's what we recommended because we knew that income drop was coming. And so there is an opportunity, oftentimes early in retirement, again, depending on your situation, where we can do some Roth conversions to help smooth out this effective tax rate in retirement. If we see once they hit required minimum distribution age, their tax rate starts to steadily climb as they get older. So by doing some Roth conversions, we're going to be able to smooth out that effective tax rate over the course of their retirement and potentially, again, based on a lot of assumptions that we have around investment returns, how much they're actually spending, so on and so forth, we're looking at potentially over 750,000 of additional value that will pass on to their kids and grandkids in their estate. And that's a big part of their goal is to help leave something for the generations to come because they never had anything like that in their life. So again, it all comes back to your goals. Just to wrap up really simply, I'm a fan. Oftentimes it makes sense to do Roth early in your career. And then as you start making more, you lose some of those deductions and credits. Switching to pre-tax later in your career can make a lot of sense as well. But ultimately, it does come down to these assumptions that we're basing in the future around taxes, around what your income need will actually be in retirement. And so we could do all the numbers today and say Roth makes sense, and the next year something changes. So it's always a moving target. It's always something we need to evaluate year to year as we go. Awesome. So just about hit 30 minutes here, which is great. Just want to wrap it up really quick by coming to some of these questions. But before we get into that, thanks for joining the webinar today. We will send out a follow-up with the recording as well as a link to view the upcoming webinars that we have coming up for the next few months. This QR code on the right here is where you can view the calendar for this year. And this QR code here in the top left is where you can schedule a consultation with us to go through pre-tax versus Roth in your situation and help you determine what's best for you. All right, so I know I talked a lot. I'm going to get to these questions here. If you're thinking of anything, type them up in the Q&A or the chat, and we can go through those. All right, so Anonymous has asked, if you only have one of these now, should you pause that to fully fund the other? or should you contribute to both? That is a great question. And unfortunately, like everything, it depends. But oftentimes it does make sense to start doing a little bit to your Roth, not necessarily completely stopping any traditional contributions or vice versa, and start doing a little bit to Roth contribution, depending on your income, of course. Sometimes we see, similar to that previous example I was showing you, if you're closer to retirement, 50, 55 or so, it often makes sense to wait until income goes down in retirement to look at doing some Roth conversions rather than starting a Roth right now. Hopefully that makes sense. Roth conversions are only possible after you hit retirement age? No. So Colin, that is a great question and a great point. Roth conversions can be done pretty much anytime, depending on your retirement plan. So if you're contributing to a 401k, 457, or 403b, you may not be able to convert to Roth until you are no longer an active employee with the company. So it depends on the plan and if the plan allows that Roth conversion within there. But Roth conversions are by no means limited until retirement. You can do those at any time. So if you have an individual retirement account, want to get someone to Roth, you can absolutely convert from pre-tax to Roth in the middle of the year. Just have to pay the taxes on that. So that's an important consideration. All right, Betsy had a question about limits to contributing towards a Roth. Are the limits that you can convert per year? Great question. So limits to contributions to these accounts, individual Roth accounts. So Roth IRAs are limited to 7,500 for 2026, and then you get a catch-up contribution as well if you're over 50. And a Roth 401k, 403b, 457, those all have higher limits. So the full 24,500 can be contributed to a Roth 401k, plus the catch-up contribution if you're over 50, that's 8,000 for this year, can also be Roth. So pretty much higher limits for the qualified retirement plans like the 401k, 403b, or 457, but you can do a Roth IRA up to the lower limits of 7,500, or I believe it's 8,500 with the catch-up for this year. As for the conversion, there are no limits on your conversion. As an example, one of Warren Buffett's investment managers that he worked with, I think this was 2008, 2009, he had, don't ask me how he got this much in there, a lot of private stocks, small positions, penny stocks. He had close to $100 million in his traditional pre-tax IRA. He converted that all at one time. $100 million converted to Roth, paid $20, $30 million in taxes to get that into Roth, and then all of that is growing tax-free. And there's, I'm sure, a lot more in there at this point. Now, he knew, because he was in the top tax bracket and likely will always be in the top tax bracket, that it would make sense to get it into Roth. That's a very extreme example. I don't typically recommend doing a lump sum conversion that bumps you up into a high tax bracket. Typically, it's let's fill up this tax bracket. So let's fill up the 12% or the 22% tax rate, and then over time you can do that a little bit each year. It's typically most efficient. All right. We had a question about the difference between a 457 and a 401k. Most people only have access to a 401k or 403b. If you work for it's a governmental 457. So a city or a state, oftentimes a school district or public entities that have a governmental 457, oftentimes have access to a 457. Very similar to 401ks, but they do have slightly different withdrawal rules if you're under 59 and a half. So you can think of them as the exact same, just the 457 is a little bit more flexible. Both have the traditional pre-tax and Roth features if your plan allows them. Like I know a number of you on here may be under the URS, the Utah Retirement Systems. They currently do not have a Roth 401k or 457 option, but that is coming, we've been told, sometime this year. So sometime middle of the year, there will likely be a Roth option for the Utah Retirement Systems 457 and 401k. Great questions. So again, we're not able to say 100% if you're in this boat, do Roth, this boat, do pre-tax, because a lot of it comes down to your goals and then your individual circumstances, which are very widely. So I encourage you to reach out to us, schedule a time to meet. Again, these are always free consultations. You can sign up and just do a quick 10-minute phone call or whatever we want to do just to review your situation, help make sure you're able to make the best decision that you can for yourself and your future. we're always happy to be a resource. Keep an eye out for that follow-up email tomorrow with the recording and for the upcoming webinars here. And yeah, again, Happy New Year, and we'll see you next time.